On June 23rd, Hims and Hers Health, a rising star in the telehealth industry, experienced a dramatic crash. The stock price plunged nearly 35% in just a single day, wiping out around $5 billion of market value. What's even more shocking is that, prior to this unexpected collapse, HIMS had been performing exceptionally well. In fact, its stock had surged by a whopping 150% in the first half of 2025 alone. So what exactly caused HIMS stock to suddenly nosedive? And more importantly, could this sharp decline present a golden buying opportunity? In today's video, we're going to dive deep into these questions, analyze the reasons behind this massive sell-off, and help you decide whether now is the right time to jump in and pick up HIMS at a discount. The immediate trigger behind HIMS's dramatic crash was a strongly worded announcement from pharmaceutical giant Novo Nordisk. In its statement, Novo Nordisk abruptly terminated its partnership with HIMS, expressing severe concerns about the company's compounded drug sales and marketing practices. For a relationship previously viewed as strategically important, such an abrupt breakup caught investors completely off guard. In fact, the partnership between HIMS and Novo Nordisk lasted less than 2 months. On April 29, 2025, HIMS announced the collaboration, allowing its users access to Novo Nordisk's popular FDA-approved weight loss drug, Wegovy, through NovoCare pharmacy services. At that time, the news was celebrated as a major milestone for HIMS's business model, boosting investor confidence and sending its stock price soaring. The market broadly interpreted this as validation from a mainstream industry leader. But before the partnership could deliver tangible results, Novo Nordisk suddenly reversed its stance with shocking intensity. In its announcement, the pharma giant accused HIMS of engaging in illegal mass-scale compounded drug sales and deceptive marketing, even labeling HIMS's products as counterfeit Wegovy. Such harsh accusations are extremely rare in corporate announcements, far exceeding the severity of typical business disputes. So why would a global pharmaceutical leader publicly issue such a strong condemnation? To understand this, we need to examine how HIMS operates in the weight loss drug market. Rather than directly selling Novo Nordisk's branded drug Wegovy, HIMS took advantage of a regulatory gray area by offering compounded medications. Compounded drugs are custom-made by pharmacists based on doctors' prescriptions, adjusting ingredients and dosages. According to U.S. law, pharmacies can legally produce these alternative medications if a branded drug faces shortages. HIMS strategically exploited this loophole. With Wegovy experiencing global supply constraints, the company partnered with compounding pharmacies to offer injections containing Semaglutide, the active ingredient in Wegovy. The biggest draw was price. HIMS charged around $165 per month, significantly undercutting Wegovy's branded monthly cost of more than $1,800. Naturally, this massive price difference became a huge attraction for consumers. However, trouble emerged as soon as Wegovy's shortage officially ended. Between April and May 2025, the FDA announced that Wegovy was no longer in short supply and explicitly warned compounding pharmacies of upcoming enforcement actions against unauthorized compounded versions. This effectively blocked the regulatory path for HIMS's business. In other words, from that moment onward, continuing to sell compounded semaglutide-based drugs would likely constitute illegal activity for HIMS. For Novo Nordisk, this issue went beyond regulatory compliance. It directly threatened their core business interests. These compounded medications bypassed Novo Nordisk's own supply chain and brand control, competing directly against Wegovy at roughly 1/10 the price. Essentially, Novo Nordisk viewed HIMS's approach as akin to selling a cheap, unauthorized imitation, a practice they could not tolerate. Therefore, Novo Nordisk adopted the harshest possible stance, decisively cutting ties with HIMS and positioning themselves as the defender of patient safety, legal integrity, and genuine branded medications. From a business strategy standpoint, this was brilliant, placing HIMS on the defensive in both regulatory scrutiny and public opinion. Facing this crisis, HIMS didn't immediately respond with a formal press release. Instead, CEO Andrew Dudum personally addressed the controversy on social media platform X. He accused Novo Nordisk of misleading the public, claiming the pharmaceutical giant had continually pressured HIMS to forcibly steer patients toward Wegovy rather than allowing doctors to choose the best clinical option. Dudum labeled these demands as anti-competitive and stated emphatically that HIMS would never yield to pressure for Big Pharma. Yet, from the market's perspective, this response seemed more like an emotional reaction rather than an effective strategy. Given Novo Nordisk's extensive legal and regulatory expertise, Dudum's statements appeared weak by comparison, failing to ease investor doubts about HIMS's business practices. So what's really at the root of this conflict? At its core, this clash boils down to compounded drugs versus branded medications, a head-on collision between an innovative business model and regulatory red lines. HIMS chose compounded medications as its main growth strategy, relying on a business model specifically designed to sidestep lengthy FDA approval processes. Unlike traditional pharmaceutical companies that spend billions developing and obtaining regulatory approval, HIMS simply repurposed existing ingredients into customized prescriptions directly for customers. This approach was indeed effective, fast, affordable, and highly appealing, but also depended entirely on a regulatory gray zone. The moment the FDA announced that Wegovy shortages were officially over and began cracking down on compounded alternatives, the entire foundation beneath HIMS's compounded drug business collapsed. Even worse, this crisis exposed serious risks within HIMS's supply chain. Novo Nordisk specifically pointed out that the active ingredients used by HIMS were mostly sourced from unauthorized overseas suppliers, lacking any FDA oversight. These materials had questionable quality and control standards, and some even contained salt-based Semaglutide variants whose safety and effectiveness remain entirely unknown. The FDA had previously issued multiple warnings about these types of compounded drugs, highlighting potentially severe health risks. For HIMS, this revelation is devastating. As a healthcare-focused brand, consumer trust is paramount, built on the pillars of safety, professionalism, and regulatory compliance. Losing this trust could fatally undermine the company's entire business model. Moreover, this incident directly threatens HIMS's long-term financial goals. Previously, the market expected the weight loss business to generate as much as $725 million in revenue in 2025 alone, accounting for roughly 30% of HIMS's projected annual revenue of around $2.3 billion to $2.4 billion. Now, this crucial revenue stream faces massive uncertainty, forcing a major reshuffle of the company's overall revenue outlook. Market reactions have clearly reflected this uncertainty. Plummeting stock prices combined with a surge in short-selling activity indicate investors are preparing for the worst. Next, let's further evaluate the actual financial and strategic impacts of this crisis. Novo Nordisk's decisive action wasn't merely the end of a business partnership. It directly attacked the most explosive growth driver in HIMS's story, the weight loss segment. To put it simply, the weight loss business wasn't just another new product line. It had rapidly become the primary driver of HIMS's financial growth. In 2024, HIMS generated around $200 million to $225 million from compounded GLP-1 medications alone. Entering 2025, this business took off even faster. Just in the first quarter of 2025, weight loss products, including GLP-1 medications, brought in approximately $230 million, exceeding the total annual revenue of the previous year in just 3 months. Before the crisis erupted, HIMS had optimistically forecasted that its weight loss business could reach $725 million for the full year of 2025, making up nearly a third of its overall revenue. But with this segment now under serious threat, or potentially eliminated altogether, the entire revenue structure and future growth expectations must be fundamentally reevaluated. From a market's point of view, this effectively triggered a total repricing of HIMS's valuation model. A valuation previously justified by high growth expectations suddenly had to be drastically revised overnight. Investors reacted immediately, explaining precisely why HIMS's stock price collapsed so sharply and dramatically. Beyond short-term financial impacts, what's even more alarming is the significant damage to HIMS's broader long-term growth vision. Previously, the company had set out an ambitious blueprint, achieving $6.5 billion in annual revenue and $1.3 billion in adjusted EBITDA by 2030. The weight loss market was explicitly positioned as a strategic pillar and critical engine for achieving this goal. Now, cracks have appeared in this foundational pillar, shaking the stability of HIMS's entire growth narrative. Investors must now seriously reconsider. Without this crucial segment, Does HIMS have enough other growth drivers capable of filling the gap left by its once high-growth weight loss business? If the answer is no, then the valuation premium that the market previously granted HIMS may no longer be justified. All of this leads us to a crucial question. Given the current turmoil, what key risks does HIMS face right now? Let's break these down one by one. First and foremost, there's regulatory risk. This crisis didn't just expose how heavily HIMS relied on regulatory gray zones. It also raised serious concerns about future scrutiny. The FDA has already warned pharmacies and platforms that continuing to sell compounded drugs after shortages officially in will result in enforcement actions. Looking ahead, HIMS could become the target of broader regulatory investigations, potentially forcing it to drastically change its entire business model. Second is legal risk. In the wake of the terminated partnership and the subsequent stock collapse, investor sentiment has turned deeply pessimistic. Numerous law firms have already announced class action lawsuits against HIMS. These lawsuits won't just result in significant legal costs. Their outcomes, whether through settlements or penalties, could leave lasting damage on the company's financial stability and brand reputation. Third is competitive risk. The weight loss segment, initially seen as HIMS's key growth driver, has suddenly become its biggest vulnerability. With branded drugs no longer available through partnerships and compounded medications under intense regulatory pressure, HIMS is quickly losing ground. At the same time, competitors are swiftly stepping in, grabbing market share, and eroding the first-mover advantage that once belonged to HIMS. Fourth, we have partnership risk. The public and bitter fallout with Novo Nordisk will undoubtedly hurt HIMS's prospects for future collaborations with other major pharmaceutical companies. Even if other firms remain interested in HIMS's tech platform, they'll now think twice, fearing similar partnership breakdowns. Rebuilding trust with potential partners is likely to become a long-term, uphill battle. Finally, and perhaps most critically, is reputational risk. For a consumer-facing digital health brand like HIMS, trust is everything. This controversy severely shook consumer perceptions about HIMS being a safe and reliable healthcare provider. Especially with questions surrounding drug safety and unclear product sourcing, HIMS faces significant challenges attracting new customers and keeping existing ones. Taken together, these risks paint a sobering picture of the challenges ahead for HIMS, shaping how investors and consumers alike will view the company's future. So, given this challenging landscape, is there still a way forward for HIMS? Could this crisis actually offer an opportunity for transformation? The short answer is yes. Even amid the storm, HIMS still has several key strengths it can rely on: a large, active user base, strong brand recognition, diverse product offerings across multiple healthcare verticals, and sufficient cash reserves to support a strategic shift. All of these factors provide a solid foundation for a successful pivot. The critical question now is whether HIMS can act swiftly and decisively to implement strategic adjustments. First, HIMS needs to rapidly accelerate the diversification of its business. Over the past year, the company has made promising progress in areas like men's health, dermatology, and mental wellness, fields that carry significantly lower compliance risks and offer promising growth potential. Additionally, HIMS has previously announced ambitions to enter the menopause care and longevity technology spaces. In the current environment, these initiatives become even more crucial. By reallocating resources from high-risk areas toward more stable segments, HIMS could effectively chart a new path to sustainable growth. Second, the company must fundamentally rebuild its approach to the weight loss market. Rather than continuing to exploit regulatory loopholes through compounded drugs, HIMS must pivot toward a fully compliant business model. This might mean securing direct partnerships with pharmaceutical companies on transparent terms or exploring FDA-approved alternatives. While challenging, this step is absolutely essential to restoring regulatory trust and ensuring long-term stability. Finally, and perhaps most importantly, HIMS needs to launch a comprehensive transparency and trust rebuilding initiative. This goes beyond simply improving product quality and data transparency. It means systematically repairing the company's communication strategy as well. Actions could include releasing detailed white papers on product sourcing and quality assurance, inviting independent third-party audits, and publicly sharing regular reports on safety and compliance metrics. Through these measures, HIMS can gradually restore credibility with consumers and investors alike. Undoubtedly, this crisis is a critical moment for HIMS, perhaps even an existential one. But it's also a unique opportunity for the company to redefine its business model and core values. Rather than continuing down a path of policy-driven shortcuts and price-based arbitrage, HIMS now has a clear chance to pivot toward a more sustainable, compliant, and defensible business strategy. Whether or not HIMS emerges successfully from this storm will depend not only on how quickly it reacts in the short term, but even more importantly, on whether it's willing to commit to structural, long-term strategic changes. Finally, let's circle back to our original question. Is now the right time to buy HIMS at this discounted price? Our take is straightforward. Not yet. And the reasons are pretty clear. Right now, HIMS is facing very real regulatory pressures and significant reputational risks, and these issues are plainly visible. Moreover, the company's core growth engine is experiencing a major disruption, while new growth opportunities remain unclear and uncertain. So, for those who still believe in the long-term potential of HIMS, there's no need to rush into buying right now. It would be wiser to wait until the company clearly outlines its new strategic direction and until the market regains confidence in its future outlook. Taking a more patient approach today might just be the smartest move of all.